Hi, my name is Darren Joseph from HEJ.tax, and we're the team that seeks to demystify this sometimes confusing world of international tax. And today I want to talk about foreign corporations. Multiple times a week, I have someone reach out to me and say, hey, I'm in the US. I want to go to XYZ jurisdiction, popular jurisdiction these days being Dubai, the United Arab Emirates. I want to go to some foreign jurisdiction and I want to set up my company. I want to invest in a company in whatever jurisdiction. But the idea is I want to structure it in a way that I can defer recognizing income in the US until there's an actual distribution. Because then you get the compounding, you get to reinvest the funds, you get to plow back in those profits, at least as a shareholder, as an investor, and have it compound and not be taxed until you pull it out. Holy grail. Everybody wants it. Everybody loves it, right? Very difficult to achieve because the US tax code is pretty smart. They've thought of that opportunity, obviously, that you won't get domestically, because then you'd be put at an unfair advantage versus those who invest in the US, right? Because they need to declare everything annually. Why should you get to defer to recognizing it until? Now, there are ways of doing it, but generally speaking, it's not that straightforward. And the reason why is because the foreign companies that have US investors, US shareholders, are classified either CFCs, controlled foreign corps, PFICs, passive foreign investment companies, or companies that are neither CFCs nor PFICs. What is a CFC? A CFC is any foreign corporation where the US shareholders, the US exposed shareholders, collectively own more than 50% of the value or vote of that company. By saying both the value of vote, we're thinking those who may go in with debt rather than equity, nominees. Everybody wants to use nominees, especially I get many people inquiring about that in parts of Asia as well as in the Middle East. They want to use nominees. Even if you use nominees, the point is that you are the ultimate beneficial owner and that person is holding that interest on your behalf. And so you're really controlling the interest via them. And if collectively the US exposed shareholders, more than 50%, it is a CFC. And there are certain anti-deferral rules that apply. The most popular of which these days would be the GILTI, for those who are in low tax jurisdictions, especially like Dubai or the United Arab Emirates. GILTI stands for Global Intangible Low Tax Income. There are other anti-deferral mechanisms, but GILTI being the most popular of them. So then the second category will be those that are classified as a PFIC, or passive foreign investment company. What is a PFIC? A foreign company is a PFIC, or passive foreign investment company, where at least 75% of the gross income for a particular year is passive income, or at least 50% of the assets are held for the production of passive income in a particular year. And now this test needs to be done on a year-by-year basis. And again, depending on the situation, the test may be administered more than once per year as well. But regardless, once that PFIC test is administered and PFIC status is triggered with US shareholders in tow, punitive PFIC tax regimes are activated. I'm not going to go into detail in this video because we've done it in a lot of detail in the articles on our website, HEJ.tax. But that's when the PFIC status is triggered. And bear in mind that a company can be a PFIC even though it generates no income, even though it generates no profit. It can still be a PFIC. So please be wary of anyone in social media promising you it's super easy. All you need to do is form a company or migrate your company overseas to a low tax jurisdiction, and suddenly as a US tax exposed shareholder, you're going to enjoy all these tax-free benefits. If it sounds too good to be true, usually it is. I mean, don't get me wrong, it is possible, but it takes a lot of structuring that you probably won't see advertised on social media. So please, caveat emptor, buyer beware. My name is Darren Joseph from HEJ.tax.